So, to help me explain a little bit more about the renovation loan process and some of the benefits that it provides for buyers and the community at large, I'd like to invite Mr. Cedric Johnson, Renovation Loan Officer at First Preference Mortgage, to help me break down the process and benefits. So, thank
Hi,
you
Cliff.
for joining me today. Thank you very much.
All right, so what we're going to talk about first is let's compare a renovation loan to buying in the future repaired value of that renovation loan versus a similar property that you're not going to do renovations on. Okay, so let's say that your sales price is $450 and you've got an improvement cost of $150. So your acquisition cost, which is the addition of the sales price and improvements, is $600. But after Phil looks at it, he says, "Hey, look, this property is going to be worth $150 when we get it, or excuse me, $650 when we get it done." So now you have an equity jump of $50,000 because you were, I'm going to compliment the buyer here, you were insightful enough to give us a call and you could understand what we're saying here to help you out. So you made $50,000 on the equity jump. Now, if you were to go out, and I'm going to call it an off-the-shelf house, just go out and buy a spot house in the marketplace, okay? And that property is going to sell for $650 to equal the amenities and the minimum property standards that your renovation house has done, okay? Well, okay, so now we're comparing the loans and what happens here. On a renovation loan, you base your loan decision on the acquisition cost of $650. So the down payment, or excuse me, of $600, the acquisition cost, okay, of $600. So your down payment is based on $600,000. With FHA, you can do this with a 3.5% down payment. Compare that against buying a property with conventional and a 5% down payment. Now, so that we compare apples to apples, let's do a $650 house, because that's how much the
comp for the after improved value was comped at $650.
Okay, and a 5% down payment. Well, the FHA program is going to have a $21,000 down payment. The conventional program is going to have a $32,500 down payment. So you're saving $11,500 off the bat on the down payment. And with the renovation, you get an extra $50,000 that the market has handed to you because you were insightful enough and trusting enough in what we're explaining to do the renovation loan. And you're not going to make up those differences because both properties are going to appreciate at the same rate. Now, let's take a look at the monthly payment and also the interest rate. So what we see here is that on a renovation loan right now, you might pay 6.5%. On a fixed rate Fannie Mae, you're going to pay 6 5/8. So the interest rate is lower by 1/8 of a percent. But it even gets more powerful because you're financing a smaller loan amount at a lower interest rate. Your monthly payment
is going to be significantly lower by comparison than paying the 5% down and the higher interest rate for the conventional.
I put in the MIP payment and also the mortgage insurance payment, so I'm comparing apples to apples. The taxes and the insurance are going to remain the same. Now, in this particular instance...
And here, I guess real quick, and I'm sorry to jump in, but just to explain for my listeners that may not know. So when you acquire a loan, if you're paying under 20%, if you do not have that 20% down, you're paying less than 20%, then there's going to be an insurance that'll be included with it as well. So he's talking about the mortgage insurance that's included with. And there's one for the FHA loan and one for the conventional loan, but basically there's a mortgage insurance payment as well.
Correct.
Yeah.
So in the FHA instance, it's $4,134, and on the conventional, it's $4,448. Well, now this is interesting. It gets really interesting very quickly because guess what? Your FHA is $334 a month less expensive than a conventional loan. Now I'm gonna take that $334 and multiply that by 360, or the entire lifetime of that loan, and add up the three cost savings that we're seeing here. Well, in this instance, 50,000 plus 11.5. Remember, 50,000 is your equity jump. 11.5 is your difference in the down payment. And the 334 times 360 is $113,068. When we add all three of those numbers up, the renovation loan over the lifetime of the note is $174,000 less expensive. So
money that you can't, money that, yeah, with the conventional loan, you just can't get back.
I don't know how to say this without being kind of, what's the right word, impudent, okay? I hope that you like that conventional house, because you're not getting that $174,000 back. You just, so the real question here, the decision
You
and
pay for that
choice.
extra equity through the life of the loan.
Yeah. So the decision and choice here is really simple. Why not buy a similar house at a lower cost?
Makes sense to me.
I mean, it's a win all the way around. Because in the renovation, not only are you fixing it up the way that you want it to be fixed up, and you're also writing those repairs off through the mortgage on your taxes. So really, those repair costs cost you, if you're in a 30% tax bracket, 30% less. When you buy any house, okay, and I've owned a number of houses, every time I buy a house, even if it's an off-the-shelf house, I always have to fix it up.
Yeah.
I mean,
depreciation, that's just how it works over time.
The former
You want
homeowner,
to personalize it.
the former homeowner is not going to change all the faucet leaks,
Yeah.
not going to fix the toilets, and it might pass home inspection, but you're going to have problems, and that money to fix those things is coming out of your pocket. And it's either coming out of your savings or it's going on a credit card. And in both instances, that makes it even more powerful or more understandable as to why to use a renovation loan, because you can put all that stuff in the mortgage and have basically a brand new house when you move in.
Like you said, designed to your specifications and needs.
Yeah.
So.